And we're back. Thanks for your letters, emails, tweets, and messages. Today's question is from Susan in Manitoba. Dear Sybil, I'm worried I may be paying too much in fees on my investment portfolio. My returns have been okay, and I really like my financial advisor, but I've been reading about lower cost alternatives. What is a fair price to pay for advice? Well, Susan, great question. And there's not an easy answer for that, but hopefully I can help clarify. It's kind of like when you're buying a car. What's the right price to pay for a car? Well, you can buy a used beat-up truck, or you can buy a really fancy Lamborghini. Different price, different value. But there are a few things for you to consider when it comes to paying fees on investment advice. Number one, what's your asset mix? If you're a low-risk investor, primarily investing in GICs, you may not pay any annual fees, but your returns will also be low. So that's something to keep in mind. If you're investing in stocks, there might be commissions that you pay or annual fees. Or mutual funds. Mutual funds have an embedded management expense ratio, and those fees are anywhere from 1.5% to as high as 3% of your money per year. But another question that you want to ask is, what is the value that you're getting for the fee you're paying? Does your financial advisor offer you financial planning services? How about tax saving strategies or estate planning? Are you in regular communication? There's a lot of tips and advice that a financial planner can give you that will save you money. So that's worth something for most people. But the most important thing at the end of the day is look at your net results. What is it you're trying to accomplish, and what is your net return? Lower cost isn't always better. Now, I always try to get a best deal. We all like deals. But sometimes when you pay too little, you may just get what you pay for. There was a Dalbar study done in Boston that looked at investors over the past 20 years. And the Standard & Poor 500 index had a return of 9.85% per year over the last 20 years. But the average investor over that same time period only earned 5.19%. That's a pretty big difference. So the study had a closer look to find out what was the cause. And it turned out that the average investor thought they could do it themselves, save fees, but their emotions got in the way. And the average investor tended to buy high and sell low. And we all know you need to do the opposite in order to make money. So the difference in investor behavior in that study cost over 4% per year. So if you're paying a financial advisor an average of 1 to 2% per year, or as high as 3%, it's still likely worth it. So the bottom line, Susan, is ask about the fees you're paying. You should fully understand what it is you're paying for and understand the services you can expect to receive. And focus on that bottom line, because that's what's going to count for you. And that wraps up this edition of The Wealthy Life, helping Canadians make smart financial decisions. Join the conversation on social media and tell us your story. Go to thewealthylife.com to ask your financial question and find out how you can make the most out of what you have.